Okay, let's unpack this. Welcome back. We are kicking off the new year, the first full trading week of 2026, with an absolute arsenal of information.
We really are.
Our source today is the one we've been waiting for, the Reserve of KAMBUF Financial News and Reports Magazine Weekly Market Digest and Investment Analysis.
And we're looking at the weekly edition from January 5th, 2026.
This isn't just a recap, it's more like a tactical blueprint.
And for a knowledge-seeking listener like you, this report is essential because, January is always the proving ground. It really sets the tone after that quiet holiday period.
It absolutely does.
So our mission today is laser-focused. We need to extract the most important financial metrics, identify those, those screaming sector trends that dictate where the money flows.
And crucially, dissect the highly detailed tactical trading strategies that KAMBUF laid out. We're moving beyond the headlines and really getting into the market mechanics. I couldn't agree more. We're looking for those aha moments hiding inside the data. And the first thing the report shows, right as the market opened for 2026, is that this is not a broad rising tide lifts all boats scenario.
No, not at all.
Instead, we see what they call selective strength. And that distinction is just it's so critical.
That phrase is everything. It tells you right away that while the indices might look impressive, we're talking all-time highs, you have to look beneath the surface.
Right.
You have to understand whose money is driving this rally and, maybe more importantly, whose money isn't.
So let's start right there. Let's get an initial snapshot of the key market metrics as of the close on January 5th. This is where that selective strength just becomes so apparent through the divergence.
Okay, so the clear leader, the star of the show, is the Dow Jones Industrial Average.
Without a doubt.
It didn't just go up, it slammed into an all-time high, 48,382.39. That's up a very solid 0.66% on the day.
And that's a clear signal, isn't it? That's deep structural, institutional confidence in those blue chip components. The cyclicals, the industrials, the old economy engines.
Precisely. That institutional strength is palpable.
But then when we look at the S&P 500, the broader benchmark, the picture is immediately more...
muted. It's much more muted.
Exactly, muted. It closed at 6,858.47. It was up, yes, but only modestly at 0.20%.
You still have to look at that year-to-date return. It's substantial at plus 17.8%, which just shows you the massive concentrated run-up that we saw in the final quarter of 2025.
True. And then there's the Nasdaq Composite, the benchmark that has, dominated for the last few years.
And it's actually lagging a bit, closing at 23,235.63, down just a tiny 0.03% on the day.
Its year-to-date return is still the strongest at plus 22.0%, which reinforces that long-term tech dominance.
Sure, but that slight daily dip suggests maybe some short-term consolidation or even a rotational pause, as money sought out the stability of the Dow.
So we have the Dow breaking records, a broad index barely moving, and the tech index taking a breather. That divergence really tells the story of early January.
It does.
Now let's talk about the VIX, because this is the real market mood indicator, and it's sending up a clear warning flare. The VIX Volatility Index is currently sitting at 14.51.
And it dropped almost 3% on the day.
A 14.51 VIX is historically low, especially with the S&P near 6,900. It just signals this profound, almost dangerous level of market complacency.
It really does. It means market participants believe the rally is just, healthy, stable, and unthreatened. And this is where the KAMBUF report's technical analysts immediately jump in with some crucial context.
Okay.
This subdued market fear is the definition of a coiled spring.
That's the key takeaway, isn't it? The compressed fear indicates a heightened risk of what they call episodic volatility expansion.
Exactly. Let's break down that mechanism for you, the listener. When the VIX is this low, it means institutional money hasn't been buying enough protective put options.
They're not buying insurance policies against a crash.
Right. The traders are essentially unhedged. So if a surprising piece of macro data hits, like a hot CPI report volatility or fear, hasn't been priced in properly, the move will be swift and sharp.
Because everyone rushes to either cover their lack of insurance or they just start selling aggressively.
Exactly.
So the low VIX creates this asymmetric risk profile where actually tactical hedges become far more valuable right now. You're paying a small premium today for insurance against a potential 1 or 2% drop tomorrow that could happen almost instantly.
It's a very, very fragile setup.
That fragility brings us perfectly into our first section, where we dive headfirst into the core thesis of the magazine, structural bifurcation and sector leadership.
Yeah, we've established the indices are moving differently.
Right. Now let's see which sectors are truly pulling the weight.
This is probably the most important foundational concept for you to understand right now. Structural bifurcation means that the index level gains, they're not universal. Think of the market as a wide, choppy ocean. The rising tide is only lifting these specific, heavily weighted cruise ships, while dozens of smaller boats are still just sitting on the sand struggling.
That's a great analogy. So let's start with those cruise ships, the index movers, or what the report calls the very strong trends.
Technology is leading the pack. It gained 1% on the day.
But the year-to-date figure is what's just staggering, up 28.5%.
Yeah, technology's dominance, primarily fueled by this AI infrastructure theme, is just non-negotiable. And communication services, which includes names like Google and Meta,
Right.
isn't far behind with a plus 25.2% year-to-date return. I mean, if you were not heavily overweight in these two sectors in 2025, you lagged the S&P 500 significantly.
It's the single biggest capital allocation decision of the last 18 months, and it's clearly continuing into 2026.
It is.
But as we noted with the Dow, the record high wasn't purely tech. The report highlighted some strong cyclical leaders that confirm that broader institutional support.
Yeah, like energy, for example, gained 2.1% on the day, pushing its year-to-date return to 8.5%.
And this wasn't just random volatility. The report specifically tied this strength to Venezuela geopolitical developments and the continued momentum of giants like Chevron and ExxonMobil.
Right, and geopolitical tailwinds often act as these powerful, non-fundamental drivers for whole sectors, especially in commodities and energy. The strength here really underscores that institutional movement towards cyclical stability and, inflation hedges.
Assuming oil futures stay elevated.
Exactly, because of that regional instability.
We also saw materials up 1.4% daily and financials up 1.2% daily. So the cyclicals are absolutely confirming the Dow's record. It's a multi-front rally, but it's not universally applied.
Precisely. Those are the engines driving the Dow. Now contrast that with the laggards, the rate-sensitive sectors.
The ones that are sensitive to the cost of capital.
Exactly. Utilities were down 0.8% on the day, and real estate was down 0.3%.
Oh, so capital is rotating out of those defensive, rate-sensitive sectors. Is KING-KAMBUF seeing this as a sign that the fear of recession is fading? Or is it more that the cost of capital is just squeezing those debt-heavy sectors, regardless of the rally?
The consensus in the report seems to lean toward the latter, the continued pressure from the cost of capital expectation.
I see.
While the market is hoping for Fed rate cuts later this year, the current rates still heavily impact sectors that rely on financing, like real estate, or that pay high dividends, like utilities.
So it's a clean rotation.
It's a very clean rotation away from sectors that thrive on low interest rates and directly into high-growth CapEx, like tech, and essential resources like energy. High growth and resources are in, yield and rate sensitivity are out.
Now, we have to talk about the structural vulnerability that underpins this entire rally, what the report flagged as the single biggest risk, concentration risk.
Yes.
This is where that selective strength becomes, well, frankly, dangerous.
This is absolutely the single defining characteristic of the 2026 market opening. KING-KAMBUF provided a truly shocking statistic.
Which is?
Mega cap tech stocks, just 7 names, account for a massive 35% of the S&P 500's weight.
35%. That is an astonishing level of dependency. And the report says this is up from 32% in 2025.
Yeah, that 3 percentage point jump in concentration in a single year just shows that capital is chasing the exact same few leaders with ever-increasing intensity.
It's incredible.
And here's some crucial historical context that the report didn't include, but you, the listener, really need to understand.
Okay.
When we look back at periods of extreme market concentration, like the peak of the dot-com bubble in 2000, we saw similar, albeit maybe slightly lower, figures. This level of concentration significantly increases systemic risk.
It's like having 7 giants holding up the roof of the market while everyone else is scrambling in the basement.
That's a perfect way to put it. And here's the implication for you. Index-level gains are completely masking underlying breadth deterioration.
So if you own the S&P 500 through an ETF like SPY or VOO,
0.35 cents of every dollar you invest is exposed to the fortunes of just 7 companies. If those top 7 names correct sharply for any reason, regulatory, geopolitical, profit-taking, whatever, the tail risk to the entire index is immense and amplified.
Let's dig into that fragility a bit more. The report notes the S&P 500 PE ratio is elevated at 27.88. But what happens if we strip out those 7 names?
If we were to remove those 7 megacaps, the PE ratio for the other 493 stocks in the S&P 500 falls dramatically. It gets much closer to the historical average, probably even below 20.
Wow.
So that 27.88 figure demands that earnings growth must accelerate, specifically in those 7 names, just to justify the current valuation levels.
So even if 80% of the market is performing weakly or consolidating, the index looks healthy, but the whole structure is built on an incredibly narrow foundation.
Exactly. The risk is twofold. First, the valuation risk in the Big 7 themselves. Second, the risk of that breadth deterioration.
Oh.
If the average stock is struggling, it signals a systemic lack of conviction in the wider economy. It suggests institutional money isn't deploying capital broadly, but sheltering in a handful of high-conviction, high-liquidity names, which makes the rally highly unstable and prone to these sharp air pockets if that concentration trade unwinds.
That's the danger.
We can transition now into Section 2. Market activity volume kings and speculative rotation. We've established the structural trends. Now let's look at the actual flow of money.
Right. Where are the institutions placing their bets, and where are retail traders maybe chasing momentum?
This section gives great insight into who is trading what, and maybe more importantly, the level of conviction behind those trades.
And the volume kings, the most active stocks by volume, are always where you find that institutional positioning. This is where the smart money is moving serious size, often ahead of big catalysts.
So let's list the top 3. NVIDIA, or NVDA, just dominates with a staggering 109 million shares traded.
At a price of $187.98. It's just stunning to think one stock now represents 109 million shares traded daily at that price point. That speaks volumes about the conviction behind this AI trade.
That volume is more than double the next name on the list, which is Micron Technology, or MU, at 42.6 million shares. And then Advanced Micro Devices, AMD, at 36.4 million.
So the interpretation from the report is pretty crystal clear.
It is. This confirms massive, sustained institutional positioning into the AI CapEx cycle. This isn't just a quarterly allocation. This is a long-term, multi-year thesis being executed right now in real time.
So the narrative isn't just a theory, it's being backed by literally hundreds of millions of shares traded daily, all concentrating in chip designers and memory producers.
This is where the heavy lifting of the index momentum is happening.
Absolutely. But also you should note the high volume activity in some secondary names.
Right.
Like Applied Digital Corp, APLD, which is up 14.64%, and Navitas Semiconductor and BTS up over 17%. These are more specialized infrastructure and power management chip players that sit a little lower down the supply chain. That suggests institutional accumulation isn't just in the trillion-dollar companies. Sophisticated money is positioning itself in the enabling names.
Exactly. The ones poised to benefit from key infrastructure announcements coming out of major events like the upcoming CES 2026.
It shows forward-looking positioning ahead of a catalyst. They're accumulating size, expecting the keynote announcements from the big players to justify the current price and drive more upside.
It's genuine accumulation, done discreetly, not just retail noise.
Okay, so now let's switch gears completely and look at the speculative surge, the retail focus, usually characterized by the top daily gainers.
Yeah, these are a totally different profile than the liquid volume kings.
These are the high-stakes, high-volatility plays. We're seeing names like Regencell Bioscience, RGC, rocketing up 34%.
And Hycroft Mining, HYMC, gaining almost 18%. And Nuscale Power, SMR, up 17.5%.
Biotech, mining, renewable energy, these are almost the inverse of the volume leaders. They're often low liquidity, deeply cyclical, or highly speculative.
And this is the report's interpretation. This reflects retail capital rotation.
Okay.
After 2025 was dominated so heavily by big tech and AI, retail capital is actively searching for value and explosive growth potential somewhere else. But KING-KAMBUF correctly notes the inherent structural difference.
Which is that these moves are characterized by elevated volatility and much lower liquidity.
Exactly. A 34% daily gain in Regencell is enticing, for sure, but it means dealing with poor execution and a much higher risk of whipsaw movement compared to trading the institutional quality liquidity of a name like NVIDIA.
The low liquidity makes execution tough, and that volatility means your position sizing has to be incredibly disciplined.
It's why institutional traders avoid these names for tactical plays. Moving large amounts of money would immediately move the price against them. These are typically short-term, sentiment-driven moves.
So to bring this idea of bifurcation full circle, let's look at the gap between the record highs versus the record lows. This really solidifies the themes we're seeing.
The companies hitting 52-week highs are almost exclusively confirming that AI infrastructure trade, semiconductors, and industrial equipment.
Right, we see Taiwan Semiconductor, TSM, ExxonMobil, there's that energy strength again, ASML Holding, and Jabil Inc.
TSM, the foundry partner, and ASML, the lithography equipment supplier, are the absolute core of the global infrastructure build-out. Their presence on the high list tells us the foundation is being laid globally and relentlessly, regardless of macro fears.
Now, compare that to the notable 52-week lows, which indicate a clear rotation away from speculative or legacy growth that might have been hot 18 months ago.
We see SoFi Technologies, SO5 Plug Power, and NIO on that list. These are typically capital-intensive, high-debt, future growth stories that are struggling in a higher interest rate environment.
The report pointed out a fascinating nuance here, which helps explain the difference between that legacy growth category and true distress.
Yes, while these stocks are near their 52-week lows relative to recent peaks, they are still significantly up from their absolute 52-week bottom.
The example of SoFi is critical. It's trading near $20 highs, but it's up a stunning 239% from its actual 52-week low of about $8.60.
So this isn't signaling a collapse or true financial distress. It's signaling that the initial speculative frenzy has cooled and investors are rotating away from debt-heavy, consumer-facing models and toward the capital-light AI leaders.
It's rotation, which is healthy, not a collapse, which would be systemic.
Exactly. The market is simply demanding performance and focusing capital, where the return on investment is most immediate and measurable: AI infrastructure.
This brings us perfectly into Section 3. The AI infrastructure strategy, top 5 stock recommendations. So KMUF didn't just summarize the market, it provided 5 highly tactical trades for the week.
And they are all focused on the core theme we've been discussing: AI infrastructure dominance.
These recommendations are designed for a very short holding period, 1 to 4 weeks, which means they rely heavily on immediate hard catalysts.
Like the upcoming CES keynotes and predictable liquidity flows. These are high-conviction tactical plays.
And crucially, the report emphasized that all 5 names offer superior risk-adjusted returns and provide that essential institutional quality liquidity.
Let's really define why that liquidity is so important for you. NVIDIA's bid-ask spread is cited at about 0.02%. This isn't just a tiny spread.
No.
It means institutions can execute multi-million-dollar positions without affecting the market price, without incurring significant slippage. This predictability is what gives them the confidence to commit heavy capital to a short-term trade.
So let's jump into the first and maybe the most essential name, NVIDIA, or NVDA, the essential play.
The thesis is simple. NVIDIA is the indispensable essential AI infrastructure play, backed by unparalleled liquidity.
And the catalyst is immediate and hard-coded into the calendar.
Right, the CES 2026 Rubin GPU architecture keynote, scheduled for January 8th and 9th. This event is expected to set the technological and market tone for the entire AI sector for the year.
The specific data points supporting the upside are pretty compelling, too. We know Morgan Stanley gave it a top 6 for 26 rating.
And beyond that, the potential upside from the demand signals, specifically the possibility of 2 million plus H200 chips going to China, provides a massive quantifiable tailwind that could lift the price target immediately.
So what's the tactical data on the trade?
The recommended entry zone is tight, $185 to $188.50. The target is $205 to $210, and the disciplined stop loss is even tighter at $180.
That stop loss translates to a very measured 3.1% risk. For that risk, the reward-risk ratio is 1.94 to 1. That is a defined acceptable risk profile that professionals can easily manage.
It's a high-conviction trade centered entirely on the success of that hard catalyst, the CES keynote.
Okay, next up is Broadcom, or AVGO Diversified Exposure.
So while NVDA is the single stock focus, AVGO provides a way to play the same trend but through networking, which is the backbone of the entire data center architecture.
The thesis here is crucial: exposure to the AI networking build-out without the single stock concentration risk of NVDA.
Right. If the whole sector sinks, AVGO will sink too, but it doesn't carry the same regulatory valuation baggage of the single largest name. And the catalyst is external validation. Bank of America named AVGO a top 6 for 26 pick.
That confirms the institutional backing, and it's trading near its 52-week highs, so momentum is intact. The report cited a reward-risk ratio of 2.04 to 1.
which is slightly better than NVIDIA's, reinforcing that thesis that it offers a solid, diversified, risk-adjusted return.
Okay, our third name is the one flagged with the highest conviction for upside, but also with the most significant warning sign. Micron Technology, MU, the explosive upside.
Yes, this is highlighted as having the highest reward potential of the 5 names. The thesis is direct exposure to memory chip demand-BM, high bandwidth memory, specifically in the AI CapEx cycle.
If data centers are being built, they need massive amounts of advanced memory, and Micron is a primary provider.
The catalysts are strong Q4 guidance and the fact that they've already exceeded Morningstar's fair value estimate, which signals a rapid, fundamental re-rating of the company based on AI demand.
But that late January earnings report is flagged as critical. That's the moment of truth where they have to show that HBM revenue growth is materializing.
And this is where we have to pause and address the risk detail. Because of that explosive upside potential, the risk is also significantly higher. The stop loss is set at $295.
Which is a 6.5% downside from the entry zone.
Right.
That 6.5% risk is a huge difference compared to NVIDIA's 3.1%. Is KING-KAMBUF classifying this as a half position size trade or just acknowledging the volatility is higher?
It's both. They recommend disciplined position sizing, a max allocation of 4–8% of your portfolio capital.
Right.
But the reason a professional trader might take that higher risk is the staggering reward profile.
Right.
The reward-risk ratio is the best on the list at 3.13 to 1. It's a classic high-risk, highest potential reward scenario, but it demands perfect execution of that stop loss.
Moving on to number 4, Taiwan Semiconductor, or TSM the moat. This introduces a needed element of geographic diversification.
And structural importance. TSM is the indispensable foundry partner for both NVIDIA and AMD. Its moat comes from its mastery of the 3-nanometer and 2-nanometer nodes. No one else can do it at scale or quality.
So TSM provides exposure to the enabler rather than the primary beneficiary. If the whole semi-ecosystem is growing, TSM wins regardless of which design house dominates.
It's the shovel seller in the gold rush. And crucially, we have to integrate the geopolitical risk here. The KING-KAMBUF report is clear. Taiwan tension isn't a theoretical risk, it's a direct supply chain threat.
If TSM's production were interrupted for even a week,
The impact on NVIDIA and AMD's ability to fulfill backlogs would be catastrophic. TSM's moat status is partially derived from its strategic importance, which is why it's included as necessary geographic diversification in this trade.
And finally, we have Advanced Micro Devices, AMD the competitor.
This trade leverages the competitive dynamic. The thesis is that AMD offers competitive leverage to NVIDIA, and alternative institutions might pivot to if they feel NVIDIA is overvalued.
And the company's own guidance suggests a really ambitious 60% compound annual growth rate in data center revenue over 5 years.
That's substantially above historical trends and confirms their aggressive push into NVIDIA's territory.
And the catalyst is similar to NVIDIA, creating this dual focus event.
Exactly. The CES 2026 Zen 6 architecture keynote on January 8th. It's expected to reignite enthusiasm, especially if their performance benchmarks are impressive and close the gap.
So it's overwhelmingly clear. KING-KAMBUF sees the AI infrastructure theme as the single most actionable area of the market right now.
Providing specific, liquid, and catalyst-driven trade setups for the first few weeks of the year.
Okay, so now we shift from stock picks to the wider environment in Section 4. Macro roadblocks, calendar events, and technical levels.
Because trading individual stocks means nothing if the macro tide turns against you, especially when market fear is so low.
This section is really about understanding the triggers for that volatility expansion we talked about. The current week, January 6th through the 10th, has a remarkably sparse earnings calendar.
Right. Only Constellation Brands and Darden restaurants are due late in the week, and they generally don't move the entire S&P 500.
The implication of that is profound. The light calendar creates a vacuum, leading to an environment where technical trading setups driven by macro flows and sentiment become dominant, rather than company fundamentals.
Exactly. When there's no major corporate news, the market tends to fixate on the few scheduled events, which in this case are those two high-impact CES keynotes, NVIDIA and AMD.
So these company events become temporary macro catalysts that fill the fundamental void.
Right. But the real, genuine volatility trigger comes from the government data. This is where you, the listener, need to mark your calendar and pay close attention.
Okay.
The report specifically emphasizes the high sensitivity to upcoming economic reports, especially the critical date of January 8th for the CPI report.
The inflation data for December.
Yes, this is deemed high importance and carries very high market sensitivity. It's the most critical piece of data this week, hands down.
So let's explore the predicted market reaction. What happens in the bull and bear scenarios according to the trading strategy?
The trading strategy is explicitly defined. An upside inflation surprise, meaning CPI comes in hotter than expected, could trigger a sharp 1% to 2% S&P 500 correction instantly.
Because it would throw the Fed rate cut expectations completely into doubt.
Exactly. The market is priced for continued disinflation and rate cuts. A reversal of that means high valuation growth stocks get hit hardest.
And conversely, if inflation surprises to the downside,
That is the green light for the bulls. A downside surprise would immediately propel the market toward that critical 7,000 resistance level, confirming the upside breakout that tactical traders are looking for.
the market's sensitivity to these figures is just extreme right now.
And it's amplified by the thin liquidity of early January.
So let's discuss the technical trading setup in light of all this.
Yeah.
The S&P 500 is currently seen as being in a defined consolidation range.
The near-term outlook is range-bound consolidation between 6,800 and 7,000. 6,800 is seen as the recent consolidation base and, crucially, the 20-day moving average.
Which is a psychological line that institutions often defend, making it a strong support level.
Right. And 7,000 is the key overhead supply zone, a major psychological hurdle that coincides with previous highs and large options positioning.
So breaking above 7,000 could target the 7,100 to 7,200 range, confirming an upside breakout.
And potentially attracting massive trend-following money. But until the macro data confirms that direction, traders should respect that 6,800 to 7,000 range.
And finally, let's circle back to volatility amplifiers. The report specifically mentions zero DTE options, zero data expiration options, and their role here. This is a technical concept that we should probably explain.
For sure. Zero DTE options, which expire at the close of trading, are highly leveraged and extremely sensitive to price movement. Their positioning creates what's called gamma exposure.
Gamma being the speed at which an option's sensitivity to price changes.
Right. So when huge amounts of zero DTE options are bought near a key level, say 6,800, the options dealers who sold them have to dynamically hedge their exposure.
So if the market drops towards 6,800, the dealers who sold those contracts suddenly have to buy the underlying stock or S&P 500 futures to hedge their risk.
Exactly. And that forced buying, triggered by the hedging mechanism, is what amplifies volatility and can cause an exaggerated bounce off support.
And conversely, if 6,800 is broken, the forced selling can cause an exaggerated collapse.
Which means even if the market is range-bound between 6,800 and 7,000, the intraday moves can be wildly volatile and unpredictable near those boundaries.
Making disciplined stop-loss enforcement absolutely essential, especially for those tactical trades we discussed.
Non-negotiable.
This level of detail leads us directly into our final comprehensive analysis in Section 5, portfolio positioning and comprehensive risk analysis.
Because understanding the risks and how to structure your portfolio is just as important as picking the right stocks.
The KMBU report provides two distinct allocation strategies, recognizing that the optimal structure depends entirely on your risk tolerance, conservative and aggressive.
And these aren't just arbitrary lists. They represent two fundamentally different philosophies.
Let's start with the conservative allocation. This investor is focused on capital preservation and stability above all else.
This approach allocates a high 35% to the broad market S&P 500 via VOO or SPY. It includes 25% in large cap tech and 15% in semiconductor ETFs, confirming that even a conservative investor cannot afford to ignore that central AI trend.
But crucially, they maintain a significant 15% in cash or bonds.
Specifically short-duration bonds or high-yield money market funds. That 15% serves as both a volatility cushion and dry powder.
It's the conservative investor's way of hedging risk without needing complicated options strategies. They're prepared to deploy capital if that 1-2% CPI correction actually happens.
It adheres to the fundamental principle that during periods of high concentration and elevated valuation, having safety assets is paramount.
Now, for the aggressive allocation, the focus shifts heavily toward leveraging that AI thesis.
This portfolio is heavily tilted toward high-growth tech, 30% allocated directly to the 5 recommended stocks, and the broader semiconductor sector, with another 20% in an ETF like SMH.
Wait a minute. So the report spends Section 1 warning us about concentration risk, the 35% weighting of the top 7 names, and then the aggressive allocation recommends piling a total of 50% into that exact same fragile sector thesis.
Right.
Isn't that structurally inconsistent with the risk warnings?
That's an excellent and necessary challenge. The report justifies this seeming inconsistency by arguing that the investor using the aggressive allocation is defined by their willingness to take measured, high-conviction risk.
Okay.
And the portfolio acknowledges the structural instability by specifically requiring a 10% allocation for volatility hedges, like VIX calls, or deep out-of-the-money put spreads.
So it's not reckless risk-taking, it's calculated levered risk that includes its own insurance policy.
Exactly. They are betting big on the AI thematic, but actively buying insurance against a tail risk event. They maintain only 5% cash, using the hedge component as their primary volatility buffer. It's a highly active strategy.
Let's quickly reiterate the critical risk warnings recap. The 5 primary landmines the report identified that every investor, regardless of their strategy, has to monitor this month.
First, we are back to concentration risk, that 35% weighting. The simple risk is that if one or two of those names cough, the entire index catches pneumonia.
Second, valuation risk. We discussed the S&P 500 PE ratio is 27.88, which the report classified as significantly elevated.
To justify that PE, earnings must accelerate. The consensus expects 8% to 10% EPS growth. If actual growth falls short of that benchmark, the market is due for a valuation repricing that could be swift and unforgiving.
Third, geopolitical risk. The report explicitly mentioned Venezuela, Iran, and Taiwan.
These are active, intertwined tail risks. Venezuela instability affects energy. Iran uncertainty affects global oil supply. And Taiwan tension is a direct threat to the entire semiconductor supply chain.
It impacts TSM, NVIDIA, and AMD immediately.
You can't execute an AI trade without pricing these active risks into every decision.
Fourth, macro risk, specifically, that inflation surprise.
We covered the CPI report, but the risk is broader.
Yeah.
Any significant shift in data that forces the Fed to reconsider its dovish stance would trigger a sharp equity repricing.
And finally, a very tactical risk. Liquidity risk.
Thin holiday liquidity in early January amplifies intraday volatility. Fewer players means small orders have a disproportionately large impact, leading to faster, more exaggerated moves.
Which is why the report insists that strict stop-loss orders are non-negotiable this week.
Absolutely.
This brings us to the core instruction from the magazine on the discipline of trading. It's not enough to know the risks. You have to manage them perfectly.
Success requires disciplined risk management and selective stock picking, not broad, passive index participation. The 5 recommended stocks are high conviction, but they demand immediate, robot-like adherence to the preset stop losses.
And the final piece of discipline. Position sizing. The report warns that the total allocation across all 5 recommended stocks should not exceed 40% of the overall portfolio, even for the aggressive investor.
That limitation is designed to prevent being overly concentrated in a single thematic trade, even if that theme AI infrastructure is the highest conviction trade in the market. It's the core tenet of responsible tactical trading.
As we wrap up this deep dive into the reserve of KING-KAMBUF Financial News and Reports magazine, let's summarize the final market outlook for the immediate future.
The near-term outlook remains range-bound consolidation, specifically between 6,800 and 7,000 for the S&P 500. We're essentially pausing, waiting for 2 key events.
The CES keynotes to confirm the AI thesis and the macro data clarity, particularly the CPI report, before the market makes a decisive move.
The first real opportunity for a directional breakout comes post-macro data, likely in the January 10th to 15th window, assuming the reports don't trigger that hard correction.
The overall takeaway for you, the listener, should be this. The market is celebrating its largest players, AI infrastructure, and energy stocks.
But this strength is aggressively masking underlying structural weakness and concentration risk. Being well-informed means understanding which stocks are driving the index and which vast swaths of the market are being left behind.
It's the difference between seeing a 0.66% gain on the Dow and realizing that a staggering 35% of the S&P 500's power is in only 7 mega-cap tech stocks. That's the structural tension we're navigating.
That brings us to our final thought. The Dow Jones Industrial Average just hit an all-time high, driven by blue-chip stability, industrial resilience, and energy strength. This suggests deep institutional confidence in the old economy components.
But the S&P 500's performance relies almost entirely on that handful of AI titans we dissected today.
So we have to ask, given the extreme concentration in the S&P 500, does the Dow's institutional stability signal genuine broad market health, a solid foundation beneath the tech frenzy?
Or is it merely masking the growing fragility caused by the dominance of those handful of AI titans?
It raises the core question of whether institutional confidence in old economy stocks can sustain a rally driven primarily by technology that might be fundamentally overbought and vulnerable to the slightest shock. This is the structural tension that will define whether January ends in a breakout or a sharp correction.
Something critical to ponder as we head into a very high-stakes CPI report this week. Thank you for joining us for this deep dive into the financial landscape. We'll catch you next time.